Hi, my name is Justin Kass, and I am the CIO of the Income and Growth Strategies for Voya. Today we are going to talk about our outlook for 2023, but before we get into 2023, we kind of need to go through what took place in 2022. In 2022, we had the highest inflation that we've had in decades. We also faced a Federal Reserve that raised interest rates at the fastest pace in decades. We had supply chain disruptions, we had war in Europe, we had continued COVID lockdowns globally, and all of this weighed on risk assets. So putting that in context, as we turn to 2023, we really need to focus on the key drivers of the market right now. And the market really seems to be focused on a couple of things, and that's inflation, the Federal Reserve, and whether we're going into a global recession. So if we take each one of those components individually, we can give you a better sense of what the income and growth team is thinking for 2023. So when we look at the inflation data, most strategists and most of the economic data we're seeing today shows that we are past peak inflation. And like I said, if you look at key strategists, many strategists have inflation coming down all throughout 2023. So the next element is the Federal Reserve. We don't know when the Federal Reserve will stop hiking rates, but one thing does seem pretty clear to us, and that's that we're closer to the end of the Fed cycle rather than the beginning. So the debate of whether peak interest rates is 5%, 5.25%, that's a lot different than where we started the year in 2022. In 2022, interest rates were pretty much zero, and we went to 4% pretty quickly. So again, we don't necessarily know the exact path of when the Federal Reserve will stop hiking rates, but one thing we feel pretty comfortable with is that we are closer to the end of a Fed hike cycle than we are at the beginning. As far as whether we enter a global recession or not, that also is yet to be determined. There is no doubt from listening to many companies globally that there is an economic slowdown happening, and many companies are reacting immediately to that global economic slowdown by stopping ordering, stopping hiring, and in some cases we're beginning to see an acceleration of layoffs. So all of the data that we're seeing today does point to a slowing economic environment for 2023. In 2022, the convertible asset class did not provide as much downside protection as we anticipated. Part of that reason is because of the rapid rise in interest rates, a little bit of spread widening, and of course, an equity market that sold off. However, that provides the opportunity set for 2023. When you look at the convertible market today, over 50% of the convertible market trades like a yield-oriented or fixed income security. So there's plenty of opportunity to get 6, 7, 8% yields in the convertible market. Plus, you still have that option or that upside because you have that right to convert into common stock. Another element that disappointed in the convertible market in 2022 was new issuance. 2020 and 2021, we saw record new issuance, close to over $100 billion. That fell off significantly in 2022. But when we look at 2023 with higher interest rates, the convertible market again becomes a very attractive financing sources for companies to raise money. So as we turn the chapter on 2022, we are optimistic for the convertible market in 2023, largely because of that yield-oriented or busted opportunity that the sell-off of 2022 has provided us.
Hi, my name is David Oberto. I'm a portfolio manager on the Income and Growth Strategies team, and I'm here to talk to you about the investment grade universe and why we're optimistic for the outlook going into 2023. First, we need to put in the context of what's taken place in 2022. You have a fixed income market that is sold off across the board, whether you're talking about treasury bonds, whether you're talking about investment grade or high yield. The investment grade universe has returned negative 15+% through the end of October. That is the worst year on record for the asset class should we finish here. What does that mean as we go forward? The return profile for the asset class typically, after a negative year, has positive returns, and in many cases has multiple years of positive returns. In addition to that backdrop, we also have a very strong fundamental backdrop. You have credit balances or cash balances at all-time highs. You have leverage back to below levels where it was prior to COVID, and you have interest coverage levels at all-time highs as well. This is a factor of two different functions. You have one, the increase in earnings since the COVID pandemic and the low in the first quarter of 2021. And you also have new issuance that came throughout 2020, 2021, and in 2022, where company management teams have been able to refinance and push out their balances, their debt balances, so that there's no looming maturity wall. This is only positive for the corporate balance sheets within the US, and one of the main reasons why we feel that in 2023, the investment grade universe should experience positive returns for the asset class. One of the other major aspects of why we're positive on the asset class is the fact that issuance has not subsided throughout 2022, despite it being a very difficult year. This has meant that corporate management teams in the investment grade universe have continued to access the capital markets. With the backup in interest rates, if you look at where we are today with a yield of 5.75%, that's relative to 2.4% to start the year. We're able to buy new bonds, add them to the portfolio at over 300 basis points increased in yield and interest. So we continue to be very positive on the asset class. So what does that mean for us as managers? That we've been able to add yield and coupon to the portfolio at levels that we haven't seen for many, many years, and makes us very excited about the ability to add that to the portfolio.
So in a scenario where we are possibly past peak inflation and closer to the end of a Fed hike cycle, that could be positive for the income and growth.
As we look into 2023, we expect another uptick in issuance from low levels of 2022 and the ability to add yield and coupon into the portfolio that we haven't seen for many, many years.
So when you look at the yield-oriented or busted part of the convertible market, the income and growth portfolio can also benefit from yields that we're seeing in that part of the convertible market. In order for us to begin to see a bottom of the equity markets, we really need to begin to see a bottoming of earnings estimates, and that's really the biggest risk that we see to 2023. We begin to see in third quarter earnings, many companies talk about slowness of growth, and that was beginning to impact earnings. A lot of companies also started talking down what they were seeing in 2023. We are very optimistic on high yield in parts of the convertible market, but again, for us to get more constructive on broad equities in general, we need to see a bottoms in earnings and a bottom in earnings estimates, and then we can move forward from there.